So, registered providers or registered social landlord finances, just a quick look at that, and these are the last sort of 4 years worth of accounts from the regulator. EBITDA interest cover is basically a gross profit. If you forget sales, interest and tax, that's your kind of gross profit, ability to cover your interest payments to banks. And that's gone up just, it took a bit of a dip and then it's gone up just in the last year. And that's quite a healthy margin, but the one to watch really is your gross profit with what they call MRI, which is your repairs, capitalised repairs, put back into the equation, because if you capitalise the repairs that you do, that gets taken out of gross profit. But if you then add that back in terms of expenditure back into your gross profit interest cover calculation, you can see that that was quite low and has only just gone back up again above 100 across the sector. And that really is probably the measure of kind of your ability to pay your debt. And that's the one that the sector's been keeping an eye on. The final one is where you take that yellow line and then you add in sales of assets, which is ones where I think from my perspective is probably you're probably gilding the lily a little bit, and selling the family silver is something that you can only do if it's worth you are doing it, and we'll come on to in terms of profitability per asset as being a key measure in the future. It's not something to keep paying your debt. So it's that yellow line that's the one of interest, and it's just starting to creep back. So the sector starting to come back into some form of operational health. Demand is still high and will remain high, and this is a slide I've taken from the HBF, who we're members of, the Home Builders Federation. The blue bars are the household growth averaged over sort of 5-year periods from the early 70s up till just now, and then these are projections. The sort of darker blue bars are the projections, the government projections, which are, as you can see, quite high, and the kind of brick bars are what the housing stock is, and it doesn't take a genius to work out that there's latent demand now and in the future. And in that respect, housing is probably as big a potential product in the kind of world of industry as most others. It's got quite a bit of latent growth and capability. Most industries are looking for market share. The housing sector is different. It's got the ability to grow into that, subject to the issues we already talked about before. So demand is definitely there. But as I said before, this intermediate market, the real disposable income, is the issue for us to think about in the sector. And here you see a couple of real disposable income forecasts. First of all, the RPI figures and projections are the green figure at the top, so that's inflation. But if you strip inflation out and you look at the real disposable income from the Office of Budget Responsibility, you can see there that it's reduced, and it's certainly the latest figure from 2010 of a 0.8% deficit was the worst record in 30 years in terms of reductions in real disposable incomes, and that's before the VAT and the tax changes went on. So the OBR, I don't think it's going to reduce as much this year and carry on increasing. CBR have a different view, probably because of the point I've just made around VAT and income tax changes that are going to hit us in the next few years. So we clearly have a demand that needs to be serviced, but a limited ability for people who want that demand, and there needs to be a way of serving that demand. The share of owner-occupied housing, this is figures from the Bank of England, has dropped recently, not surprising because of the mortgage issues we know. The guy that presented this slide last week, David Miles, who's on the banking MPC, the Monetary Policy Committee, had also done a little bit of a calculation for the next 4 years. He'd assumed that there was hardly any first-time buyer mortgages for the next 4 years. And his conclusion was the impact would be that would go down from 68 to just below 65% if that was the case. So you can see a huge opportunity for the rented market coming in here. So housing in the rented format, more so than in a pure owner-occupied, or maybe housing in a rented and a shared ownership or a shared equity market is where the market opportunity lies. That's the inverse of this. So what does this boil down to? Well, the opportunities in terms of new tenures, those are the ones I've just talked about in terms of that intermediate market and rented in particular. is a clear opportunity in the next 5 years for the housing market. New strategic alliances, local authorities, because the powers that local authorities are getting to deal with land and assets like housing are more so than they've ever had in the past. And working together between local authorities and housing providers, I think, is going to be a strategic opportunity for the future, as is the opportunity with house builders, who traditionally their business model is predicated on more house sales than rented housing. And I think they're going to need to find some form of strategic partners to be able to execute their plans in the future. New funding streams for energy starting to come through, as you'll see, and I think that's one to watch. And new investment into the sector. Bond markets, you've probably seen that the housing market, housing finances in the last 2 years. The last 2 years, each year, it's been about £1 billion worth of bond finance that's come into the market. We, along with a few others, have gone and tapped the bond market for different finance, simply because the debt markets that we talked about before, the big commercial banks lending debt into the sector, are finding it more limited, and will find it more limited. There's the issue of REITs that's a possibility in the residential sector, and that's a real opportunity, I think, for the residential sector to get their heads around. REITs at the moment in the UK are very commercially focused, so the office buildings tend to be REITs structured. The government have signalled that they're interested in developing REITs for the residential sector, which would be a big opportunity. It kind of comes back to the point I made earlier. The government are looking to find a way of privatising, in a small p world, the housing sector. And so finding tax breaks in REITs for the housing sector is something that I think we all need to keep an eye on and out working through. The risks at a kind of more mundane level, we talked about benefit payments potentially going direct to customers. That will increase arrears, and we can see that coming in say 4 or 5 to 6 years' time. That's something that's definitely coming down the pipeline, whichever government it is. Benefit payments will probably end up direct with the tenant, with the customer. So the arrears situation is going to be something to really manage. We talked about above inflation increases in external costs, notably repairs, because of energy costs and VAT. That's something to really manage. Clearly less grants and less local authority services as a result, so that the complementary work that housing associations do and housing providers do with local authorities needs to be tighter and more managed and more focused and better planned. And we talked also about the debt lending, and clearly interest rates will go up on debt lending. Is there any other opportunity for other finance? Well, we just mentioned maybe REITs and other forms of finance that would help for that. So what are the implications for planning performance? I just picked a few here just to give you a flavour. For me, it's really back to business basics, and the cash management, needless to say, and it's been quite a key issue anyway over the last 2 years, is going to be even more key in the future, because you just want to reduce your ability to go out and lend, or sorry, borrow. You just want to keep that cash as long as you can. The other interesting factor for me is asset management, because I think as the sector has now opened up, and the government are freeing the sector up a bit from the previous kind of very binary shackles the regulator had around, you had to get every house signed off to be able to sell it, but that's opening up now. As that's opening up, then more proactive management of the assets is really going to be a focus for the housing sector. In other words, checking that you are making your profit you think you're making on some of those properties that are out there, more so than it has been in the past. And indeed, in that asset management vein, there's already a move by quite a number of operators to work out which localities they want to operate in, not just in terms of the local authority they want to be working with in terms of partnerships as well, but also which other housing providers they want to be working with, and maybe sharing the management responsibilities, dividing them up across the country. So there's quite a lot around asset management that's coming through and will come through in the next few years. And customer service, absolute key here, is to make sure that we are still delivering service to the customers, even though there's a co-regulatory responsibility. That puts more onus on the housing associations and the housing sector to provide customers with top-notch service. But what we've got at the moment, though, in the sector, and I come from outside the sector, I'm 5 years in from the aviation sector, is a really silo approach. Not just in terms of individual organisations, there's thousands of different housing associations and housing companies, but within each organisation it's very siloed. So planning tends to be, and this isn't the case where we're at by the way, but planning tends to be focused on key stakeholders. When you go and talk to housing associations, it's very focused on key stakeholders, not focused on the scenarios I talked about earlier as much as it should be. So I think more planning in terms of scenario planning is absolutely going to be the key. Performance has largely been driven by the regulatory tick box. So you sit in front of the regulator and they say, how are you doing on these key indicators, and why aren't you doing that to improve your key indicator in this area, because Housing Association X is doing that and they seem to have done very well. Well, it's actually now more about how well you're actually delivering service and how you can prove you're delivering service, than it being a tick box approach in a very kind of black and white regulatory environment. So performance is going to be really driven by frontline measurement of customer service. The finance has tended to be a little bit historic in my view from what I've seen, but as you can see from the scenarios I painted earlier, it's going to need to look 5 to 10 to 20 years ahead to be able to finance the growth from different forms of different types of finance than has historically been in the housing sector. So that's going to be require different kind of management, different kind of planning. And risk has tended to be a bit of a textbook exercise and not really linked as much as it needs to be across the sector. And that's my personal view. We tend to operate slightly differently in places for people, but I guess there are some people that are not operating like that, and there will be some people that are operating like that.